Hello and welcome to our Q1 2022 update. My name is Jordan Gillis and I'm one of the partners here at Saltus, and I'm joined today by Mike Stimson, who's a member of our investment team and who's going to take us through the update.
Hi, Jordan. I've got to say, it's great to have you back and looking far less tired than I was expecting. For those of you that don't know, Jordan's just returned from a couple of weeks of paternity leave, welcoming baby Evie. So it's great to have you back, Jordan.
It's very good to be back, and yes, apologies for the delay, but I've been working on becoming a nappy changing expert the last couple of weeks. So anyway, on to more serious things. So this first quarter has, been one to remember, and perhaps, the most significant quarter many of us have seen, in living memory. Inflation is reaching new heights, a level to which a generation have never seen. And of course, there has just been the terrible war in Ukraine, which is exacerbating that situation. So, Mike, given there's been so many significant movers, do you want to just give us a summary of what has actually been happening in markets over the last quarter so people understand what the context is?
Sure. So I think the first thing to say is that things have changed, and we have had to adapt portfolios because of that. And the thing that's changed is that interest rates are going up in the West to deal with inflation. And the speed of the increases in those interest rates is now expected to be much faster than was expected in December. And this means that markets have priced in central banks actively trying to slow economies. In the US, for example, an entire interest rate cycle has been priced in just a couple of months. And when you combine that with the war in Ukraine, and please forgive me for if it sounds like I'm speaking dispassionately here. I don't mean to diminish the human suffering, but we have to think about this in economic terms, as this is the world that we live in. But what the war has really done is exaggerated existing trends of rising inflation and slowing growth. So increased commodity prices effectively act as a tax on growth, and at the same time give inflation a boost. And so while obviously the war is worst for people of the Ukraine, it really has made things more difficult for everyone. And what this has led to in markets is it has been very disruptive, particularly in the bond market. A global bond market has had its worst quarterly performance in about 30 years, and this has also spilled over into equities. And so we've had a lot of volatility to deal with in the first few months of this year.
And so, Mike, one of the questions that I find people often asking me are, given that inflation was already on the rise anyway because of COVID and supply chains, and given that Ukraine and Russia are relatively small economies on a global scale, why has the war in Ukraine really exacerbated that picture to such an extent?
Sure. While Ukraine and Russia are relatively small economies on a global scale, they are very significant producers of both wheat in the case of Ukraine, and oil and gas in Russia. And so what that means is that because the Ukrainian harvest effectively won't exist this year, there'll be far less wheat around, and that's driven the price of wheat up. And likewise, Russia's oil and gas supply has significantly reduced. That has driven the price of oil and gas up. And both wheat and oil and gas are significant inputs into the global inflation number.
Okay, so we've got rising commodity prices, rising inflation, volatile equity markets. How have we responded to that sort of storm and headwind in the portfolios then, Mike? What have we actually been doing?
Sure. So we think we're moving into a later stage of the business cycle. And so normally that would mean growth remains positive but is slowing. Inflation should be starting to come down, but is sticking higher due to the war, as we've just talked about. And so what we need to do is adjust the makeup of portfolios. And in the equity portion of the portfolios, what that really means is increasing the quality. And when I talk about quality companies, I'm talking about companies that have high returns on equity, that have strong balance sheets. We're also continuing with our tilt towards value companies over growth, but not trying to make too big a call there, as frankly there's just too much uncertainty at the moment. At the other end of the scale, in the bond market, for the first time in about 15 years, we're actually buying some short-term government paper. So we can now own a 2-year US government bond that gives us a return of over 2.5%. And while that may not sound very exciting, particularly with inflation so high, actually, as a safe haven asset offering genuine diversification, we think this is an attractively priced defensive asset.
And can you just explain that a bit more, Mike? Because obviously we've just heard, how terribly the bond markets are doing from you. So how does that tie in with deciding to get into short duration bonds in that context?
Well, without sort of wanting to sort of make it too simple, but after very significant falls, it's a much more attractive time to buy, frankly. And so given the bond market has had such a terrible time, for the first time, we think we can see some value in short dated paper. And really, we're looking to buy these assets as an insurance policy. If things get more difficult, if we move into recession, which isn't what our base case outlook is, but it's certainly something that's possible, these bonds will perform very, very well and give us some protection in the portfolios. I think also our alternative strategies have also been a really big help over the last quarter. Obviously, the commodity holdings have done very, very well, but also our strategies that benefit from volatility, the macro funds have made double-digit returns. And those are really the investments that we've held instead of bonds, instead of credit. And so that's been a really good trade this quarter.
And so are we moving out some of the alternatives to move to sort of overweight to those short-term bonds, or is it just some tweaks around the edges?
No, it's more around the edges, and we're using cash to buy those bond positions. We think alternatives are a really attractive investment in this environment, and expect to maintain our exposure through the next few months.
Okay, great. So dare I now move on to ask you, what the outlook might be. I suppose this is the question on everyone's lips, particularly around inflation. What do you think the future looks like this year? And is inflation going to come down? And how are we going to respond to the sort of continuously changing situation?
So I think what we have to remember about inflation is that in order for inflation to stay high, to stay at 8% or whatever the number is, you need the price of these assets to continue to go up quarter on quarter on quarter. And we think it's probably unlikely for the oil price to go up 25% every 3 months, into perpetuity. And therefore, what that means is that we think inflation probably is peaking and probably will come down through the rest of this year. I feel sort of slightly uncomfortable saying that, given that's what we said sort of 3 months ago, but obviously the war is a catalyst that well explains why this has been drawn out a little bit more. So yes, we do expect inflation to remain higher than it has been, but to come down from these levels. And given that outlook, we think there is quite a lot of bad news already in the price in certain markets. And as we look around across asset classes, we think we can find enough good ideas to make use of risk budgets. And so if I sort of had to summarize the outlook without trying to sort of sound too flippant, we don't think it's time to ring the alarm bells. It's not an easy period to be managing money, but we think we can find opportunities. The key at the moment is we have to stay nimble and very focused on current events, because things are changing very, very quickly, and we need to keep adapting portfolios to those changes.
Okay, so a bumpy ride perhaps, but as long as we stay nimble and reactive, you think we can find our way through?
I think that's a very good way to summarize it. Thanks, John.
Wonderful. Okay, well, look, thank you so much for joining us for this quarterly update, and we look forward to seeing you again next quarter.